watching Stockwatch. I'm Zinati Kuma, and joining me to unpack your stock-related questions today is Zwelakhe Mnguni from Benguela Global Fund Managers and Ricus from PSG Hole in One Ruimsig. We are pre-recording the show. Just a heads up to our viewers, we always pre-record the show on Mondays and Wednesdays, so please ensure that you send your questions in the morning on those days so that we can get to them. But do continue to send your questions either way so that we can get to them on the other days as well. Email stockwatch@bdtv.co.za via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Thank you so much for your time, gents. Oh, it's a Monday, but it's already gotten off to a very, very rocky start. Let's talk about the tech route that we are seeing on display today. Let's deep seek into that sell-off, starting with you, Ricus. Just talk to me about what investors are running away from here when you look at particularly the US AI stocks.
Well, the background to this is that China has released a AI model that is almost as good as anything the Americans got, is a lot cheaper to run, is open source. In other words, everybody can see how it does things. And it has put into perspective the amount of capital that American companies in the AI sector has spent on buying chips from Nvidia in order to drive their models. So all of a sudden, the perception is we can use a Chinese model, which is open source, which is much cheaper. And what about all the capital spend that all these companies, all the American companies have done on their products? It has not necessarily changed the market, but it has started asking questions about that market. And if you take a look at some of the stocks in that sector trading at sky-high price earnings, the question is that a realistic valuation? And as a result, we're already seeing pre-market opening things like Nvidia down 10%. Over in the Netherlands, ASML is about 7-8% down. So there's going to be a bit of a shakeout.
Yeah. It's actually a quite a hectic thing that is happening there, because, I mean, you look at a company like Nvidia, Zwelakhe, falling 10%. Just talk to me about how you're viewing those AI stocks in the US right now, if they can literally just over a few hours sell off like that.
Yeah, Nati, thank you. I think it just highlights the extent to which the market had pushed itself to levels so high that if expectations don't materialize, there was risk. And I think what the American model has been all about, it's been about getting more processing power. Now, that's why Nvidia has done so well, because they were guys are buying chips, and they're thinking that they can out-process the other guys. But it sounds like this DeepSeek has gone a different route. They've designed the algorithm, and mathematically somehow they've been a lot more efficient. And if you compare the cost, it now suddenly says, as Ricus says, you know, the guys have invested so much money and other guys can do it for $6 million. It does raise questions about the recoverability of capital. And I think the likes of Nvidia, the question mark is, if this thing is open source and the data that algorithm could be shared across, would everybody need the same amount of chips as last week or a month ago? I doubt it. I think there could be a change in approach, and that is a big risk to Nvidia. So I think, like everything in America, I mean, it starts with a hype, and you end up with some correction. You can go look at how they went into the telecoms data when they were changing to fiber. You can see how the internet in the first phase, this is the AI wave. It will have a meaningful impact. I think the AI concept, the AI value is enormous to the world, but the processing behind it might change as we go along.
I mean, just looking at the fact that I mean, this challenge is coming from the Chinese tech sector, Ricus. Obviously, I know that when you look at Chinese stocks, you kind of figure that they are cheaper for a reason, but at the same time, a lot of investors seeing value in those Chinese stocks. Does this maybe also just highlight just how much value does exist in the Chinese stock markets, particularly when it comes to tech, and then compared to the US tech stocks that are really very frothy at the moment?
Yeah, there's no doubt that the US tech stocks are frothy, so one can expect a pullback there. As to the value of Chinese stocks, there's no doubt that they know what they are doing. But for viewers my age, the parallel here is what happened with Sputnik in the space race in the 1960s. The Russians did something which was technologically very advanced, as we can see with DeepSeek. But that doesn't mean that companies like OpenAI is all of a sudden going to say, oh gosh, we have lost the race.
Okay.
They are already working on ways to counter this, and America has and still is a leader in technology and innovation. So this is a setback. It doesn't reduce the value of the AI sector.
Okay.
It impacts certain stocks, but I have very little doubt that the real value to be had in the longer term will still be in US technology and development.
All right. I get your point there, Ricus, that it does impact some areas, but generally at this point, maybe not necessarily changes the structure of that tech sector. Looking lastly on this, Zwelakhe, looking at the fact that also the technology space has also been at the center of geopolitical tensions between the US and China. Do you think that this could impact those relations on some level?
Look, I don't see a major impact from that angle in terms of the AI sector. I think the bans and the sanctions have been put in place by the previous administration, and the current will probably try and accelerate that.
Yeah.
But I do think that it has given China an opportunity to operate within a closed economy and develop their own technologies, and they seem to be leapfrogging in many ways.
Yeah.
In the last time we had how Huawei went to, I think, 3 or 4 nanometer chip, which was not expected with the equipment that they had. And today we've got AI that just come out a lot more cheaper. So there is impact of tariffs, but it also gives China the opportunity to basically build their own platform. And I think long term, in as much as I agree with Ricus about the US leading the technology sector, I think the applications probably lead. But if I think long term, I think the geopolitical relations might actually favor China, where the US has made so many enemies. Their technology might find penetration into other markets at a much cheaper price. And that could be how it plays out in the long term.
This is going to be a very interesting industry to watch. So we will definitely be keeping a close eye on that. Let's go into the other side of the stocks, I guess, more value stocks rather than growth. British American Tobacco. Ricus, I see that it is up at the moment as we are talking, and it's been going up. Right now, it's up almost 7%. What is happening today?
The main news on that is that the US Federal Drug Administration, which had been pondering rules that had to do with the flavoring of both cigarette and cigar tobacco, which would have impacted on menthol sales in the US, which is a big part of British American Tobacco's sales. The FDA has pulled back on those rules. In other words, they scrapped it for the moment. Doesn't mean that it can't return into some form or fashion, but that sword has been hanging over the British American share price for a long time now, because if those rules were enacted, it could have meant quite a loss in market share for British American Tobacco. That's away now. That's why we're seeing the rally. The share price is breaking to probably 1 year highs. And just had a quick look at a chart here, and it looks like it could easily do a 15% rally.
Wow.
Longer term, it's still a tobacco stock. It's still a dying industry. Trading opportunity only as far as I'm concerned.
I mean, it's quite interesting that this is a regulatory move, and I mean, one of the overhangs on British American Tobacco has been that, and I guess even particularly for the new categories, the vapes also, we've had some things happening there in the UK. This is good news, Zwelakhe, but over the long term, do we still have some sort of regulatory overhang there, even though at least they've gotten over this one in the short term at least?
Yeah, look, since I started in the industry, the tobacco companies have been regulated, and that's over 20 years ago. And I do think that we're going to see these companies trying to refine their business models to try and accommodate regulatory pressures. I think that the new generation products that British American Tobacco has, they seem to be driving growth, and I think they will probably replace the majority of the typical cigarettes. And yeah, regulation might not kill them, but they will come under pressure for quite some time.
Yeah. So, I mean, at this point, because, I mean, obviously now, because of what we've seen with Reinet basically getting rid of their stake in British American Tobacco, Ricus, you say that it is a dying industry, a sunset industry. Was Reinet right in letting go of BAT?
Yeah, I think so. I mean, there's a certain section of your population that will always be addicted to something. So there will always be somebody that will be addicted to nicotine, which is one hell of a drug, by the way. But it's basically not socially acceptable anymore. There's a smaller minority of people who smoke, whether it be vape or traditional cigarettes. So there's no growth prospects in that. The product mix might change, but the industry itself is certainly ex-growth. And Reinet has obviously come to the point where they say, well, it doesn't matter if we get great dividends, but surely we can use our money better, specifically as we also have a generational change in the management of the Ruperts going forward. I think that's part of that disinvestment.
All right. I wanted to ask about the miners, because there's also a heavy sell-off happening there today. Anglo-American, Amplats, Sibanye-Stillwater, all down 5%. So is Implats, Kumba Iron Ore. What is happening, Zwelakhe?
Yeah, look, I'm not so sure, but I think the fact that we are not seeing any meaningful change in stance by the Trump administration on China. I mean, he's made threats, and it's been quite confusing reading whether he will move ahead with those. But on the Chinese front, I think we are struggling to see the actual heavy investment that would suck up resources. So it is the volatility that I think will probably stay with us for a little while. I mean, in rand terms, gold is up, but even though marginally, I do think that there is a bit of volatility in the market at this stage.
Yeah, and it's actually quite interesting considering that last week, I think Friday, we got news of a better performance there in Richards Bay, the coal terminal there. Of course, we know that has been definitely an Achilles heel for our mining sector. Ricus, any view on why the miners have taken such a pounding today?
Okay, the macro answer to that is Chinese productivity numbers that came out this morning, which was well below expectations. And as we know, China is the market for commodities. I'm talking about commodities apart from gold. Gold is its own story at the moment, as a safe haven. But the impact today is China's productivity the impact on Anglo specifically is a report in the Financial Times over the weekend that Billiton has put any future buying or bid for Anglo American on ice.
Oh.
Because, quote unquote, the prices of Anglos is too high at the moment. So that's a bit of a double barrel as far as our market's concerned. On the other hand, I think it is getting support, as Smart has said, possibly Transnet getting its act together. It's future music, but at least the signs there looks positive.
I mean, it's interesting that also investors would also, I guess, react like that with Anglo American, because I would have thought that investors were settled on that whether BHP buys Anglo American or not, Anglo American is going to be fine because of the strategic overhaul that it is going under at this point. So, like, just your thoughts on that specific picture.
I think the market is finicky, but I think if one looks at what the BHP bid would have done, is it would have fast-tracked the realization of the discount that was in the valuation. It would have brought forward quicker compared to what they said is the value unlock process, which is taking long. So I do think that there was a bit of a buyout premium that was embedded in the price, that, or at least that was an underpin. And if you take that away, you'd likely see that the market would take a dim view of that because it's a hard slog getting the value unlock out.
But just on that, Ricus, drilling into Amplats, this wouldn't really affect that anyway, right? Because it's still Anglo American is still kind of letting go of it, whether BHP buys it or not.
Yeah, precisely that. As to why the platinum sector is down, I think that's just the platinum price at the moment. You know, as opposed to gold, which is knocking on new all-time highs, platinum is actually down from Friday morning.
Yeah. And actually, just as well, like, how do you even approach these platinum stocks? Because, I mean, obviously, we can't ignore the short-term moves that are happening in the platinum price. But at the same time, longer term, it seems that everything is quite supportive. We're looking at the fact that, for example, in the automotive sector, that people aren't too keen on EVs anymore, that people are still banking on ICE cars carrying on, but also maybe if you are going to go another route, then it's going to be hybrid, which still do need PGMs.
Look, I think one of the biggest down legs came from the German situation, the energy situation that led to the production coming under pressure from the German auto industry. I do think that maybe the next 2 years, we might see Trump's policies benefiting some of the US auto manufacturers. But I think it is a tough situation. I mean, the change in policy around the emissions and Trump exiting the Paris Accords, I thought it was quite a bad signal for the auto industry, in that guys on an annual basis or periodically, they would increase their PGM loadings on the AutoCADs because the regulations were getting tighter. And if that gets lost, you're probably going to see guys running these things at the same PGM loading. So while volume declines on the auto industry, you might also see that the loadings are not increasing, which is something that used to offset the pressure in the past.
All right. Gents, there have been quite a few retailers coming out with numbers. Recently, I think last week it was the Foschini Group, and then today it was Lewis, seeming that Lewis is constantly outperforming. Is it a good time, Ricus, to be a retailer, and is it a good time for investors to be in retail at this point?
Apart from Lewis, excuse me, oh, sorry about that. Well, okay, let's just start off with Lewis numbers.
Yeah.
It was very, very good across the board. Maybe a slight increase in creditor provision, but from everybody that's reported, I mean, that certainly was the best results. But I think following the Mr. Price update, the Foschini update on Friday, people have taken a look at the retail sector, specifically those consumer goods, and just said, hang five. We're sitting at quite perky valuations here. I think it's time to take some money off the table, because in general, they weren't all that great.
Okay, I hear you.
I think there was an over-optimism as to the possible benefit of the GNU, which is also at the moment under pressure, and I think that negative sentiment combined with results not as good as expected is putting pressure on the share prices of that whole sector.
You're actually right, because it's only Lewis that's up about 5%, but then you check the Foschini Group down over 2%. And I'm also just checking Mr. Price. By the way, apologies to our viewers that we are not showing graphs at this moment, but we are sorting that out. Hopefully that will be sorted out in the next week. Even Mr. Price down 3%. Zwelakhe, what would your view on the retailers be? And at this point, is it a case of not all retailers are equal?
Yeah, look, I'd be more still cautious about the outlook. I agree with Ricus. There was an excessive appreciation of the GNU benefits, and I think as time rolls forward, we are seeing that those benefits haven't materialized as expected. So I would be a bit more cautious, but I'd still, if I wanted a defensive within that area, I'd still probably hold on to Mr. Price. I wouldn't go out and rush to buy it, but I'd be a bit more cautious. I think the Foschini numbers were not great. I think Lewis, I'm actually encouraged by the numbers in that I often check how the trade-off between cash sales and the credit sales go. It looks like it was on both sides very strong. So it's not that they opened the credit taps to support sales growth. So it was good in that sense.
What about the property companies that house those retailers? So we did have Vukile also out with the numbers from the festive season as well. Also really reporting strong numbers there in both the domestic operations and also the operations in Spain and Portugal. Would you be eyeing those property counters that are exposed to the retail sector, Ricus?
Well, I'm sort of taking a look at all property companies, because I think that sector, not only locally but also overseas, are in a bit of a pullback at the moment, directly as a result of what is happening with, or what's going to happen with interest rates, specifically in the US, where it's probably not going to get cut as often and by the margin that people thought 2 or 3 months ago. So if you start doing yield comparisons on your property versus what you would get on a bond, maybe property is all of a sudden not that attractive anymore, and we're seeing a bit of a pullback. I still think at lower prices it's not a bad place to be, depending on which company you choose.
All right. Well, gents, we do have to get to your stock picks for today's Zwelakhe. What are you betting on today?
Yeah, I'm going with a stock called Cactus. They are a service provider to the drilling, oil drilling and gas drilling in the US. Quite a decent company, very well run, with own manufacturing of pipes that go into this plants that produce gas. So it is trading at about 15 times forward. Not a bad stock. I think there could be a tailwind of more drilling in the US that would be supportive of this kind of stock, but certainly a very well-run company in a market that they could still gain more penetration.
Quite interesting, because it really speaks to the point that Grant Nader from Benguela Global Fund Managers made also last week, that maybe not look at the oil companies, but actually the oil services companies that will help with this drilling activity. Ricus, on your side, what are you choosing?
Yes, on a day like today, I just scratch my head, because I think we're going to see a lot of volatility in markets. So I went for something I think pretty safe, which is Quilter, listed locally and in London. And they're listed in London because that's the main base of their operations. They're an asset management company, very much like PSG. In other words, they manage assets, and they also have an arm that sells products to high net worth individuals. And the growth in both assets under management, plus the gains from their platform, the latest sets of results looked very, very good. And I expect that to continue. I think they're quite offensive, and the price is breaking to a new high, which I also like, new 52-week high. So yeah, it's a safe, reasonably safe bet in current circumstances.
All right. Well, thank you so much for your time and for your analysis today, gents. Much appreciated. That is all for Stockwatch today. Thanks to our guests, Zwelakhe Mnguni from Benguela Global Fund Managers and Ricus from PSG Hole in One Ruimsig. Up next, the close day watching.